Have you ever wondered how to start investing with just $100? Let's delve into the power of investing, even when it starts with such a modest sum. It might seem like a small amount, but don't underestimate the potential of that $100 bill in your wallet. It's not about the amount you start with, it's about getting started. Investing is like planting a seed. At first, it's just a tiny thing buried in the soil. But give it time, water, and sunlight, and it transforms into a thriving plant. In the same way, your initial investment might seem small, but with time, patience, and the right conditions, it can grow into something much more substantial. The key here is to start early. The sooner you start investing, the longer your money has to grow. And this growth isn't linear, it's exponential. This is because of a beautiful financial phenomenon known as compound interest. So, what is compound interest? Well, in the simplest terms, it's earning interest on interest. You see, when you invest money, it earns a return. If you reinvest that return, it can earn its own return. Over time, this process can lead to your investment growing at an accelerating rate. The power of compound interest is what allows a small sum, like $100, to potentially turn into a much larger amount over time. It's like a snowball rolling downhill, growing bigger and bigger as it goes. But remember, investing isn't just about growing your money. It's about putting your money to work. When you invest, you're essentially buying pieces of businesses or lending your money to them. In return, they share their profits with you in the form of dividends or interest. So, instead of you working for your money starts working for you. Imagine the possibilities if you could harness the power of investing and compound interest. Imagine what you could do with a $100 investment if you knew how to make it grow. Before you start investing, it's crucial to understand some basic concepts. Firstly, let's talk about risk and return. In the world of investing, risk refers to the likelihood that your investment value might decrease. Return, on the other hand, is the money you make from an investment. Generally, the higher the risk, the higher the potential return. However, this also means a higher chance of losing money. It's important to find a balance between risk and return that fits your comfort level and financial goals. Next, let's delve into diversification. This is the practice of spreading your investments across different types of assets to reduce risk. Think of it like not putting all your eggs in one basket. If one investment performs poorly, others may perform well and balance out your overall portfolio. Diversification can include a mix of stocks, bonds, real estate, and more, depending on your risk tolerance and investment horizon. Speaking of time, let's discuss the time value of money. This principle suggests that money available at the present time is worth more than the same amount in the future due to its potential earning capacity. This is why we invest. By investing your money, you're giving it the chance to increase in value over time. Finally, let's touch on the types of assets you can invest in. Stocks represent ownership in a company and can provide high returns, but they also carry a high risk. Bonds are loans you give to a company or government entity, which they promise to pay back with interest. They're generally safer than stocks but offer lower returns. Real estate can provide income through rent and potential appreciation in property value. Mutual funds and exchange-traded funds offer diversification by pooling your money with other investors to buy a variety of assets. Remember, investing is not a one-size-fits-all scenario. What works for one person might not work for another. It's about understanding your financial goals, risk tolerance, and the time you have to invest. Armed with these basic concepts, you're ready to make your first investment. Now that you're ready to invest, where do you start? Let's dive right in to explore the different platforms where you can begin your investment journey with just $100. First off, let's talk about robo-advisors. These are automated platforms that use algorithms to manage your investments based on your risk tolerance and financial goals. They are a great option for beginners because they take care of the heavy lifting of investing for you. You just set your preferences, and the robo-advisor does the rest. Next up, we have online brokers. These platforms allow you to buy and sell investments on your own. They offer a wide range of investment options from stocks and bonds to mutual funds and ETFs. If you're someone who likes to take a hands-on approach and wants to make your own investment decisions, online brokers may be the right fit for you. Lastly, there are micro-investing apps. These platforms allow you to invest small amounts of money regularly. Some even round up your everyday purchases to the nearest dollar and invest the change. This can be a fun and effortless way to start investing without needing a large sum of money up front. Now, no matter which platform you choose, there are a few key factors to consider. The first is fees. Some platforms charge a flat fee, others a percentage of your investment, and some even offer free trades. Make sure to factor in these costs when choosing a platform. Next is ease of use. You want a platform that's user-friendly and fits your lifestyle. If you're always on the go, consider a platform with a robust mobile app. Lastly, consider the resources available. Does the platform offer educational materials to help you understand investing better? Are there tools to track your progress and adjust your strategy? Remember, the goal here is to find a platform that aligns with your investment goals, your comfort level with technology, and your budget. Choosing the right platform is a crucial first step in your investing journey. So take your time, do your research, and make an informed decision. Happy investing! You've got your $100 and your investment platform. Now, what's next? Well, the next step, arguably the most critical one, is choosing what to invest in. It's not just about picking the hottest stock or the trendiest ETF. It's about making an informed decision based on your financial goals, risk tolerance, and investment horizon. Start by identifying your financial goals. Are you investing for retirement, a down payment on a house, or maybe your child's college fund? Your goals will help guide your investment choices and determine how much risk you're willing to take on. For instance, if you're investing for a long-term goal like retirement, you might be able to handle more risk and therefore invest more heavily in stocks. But if your goal is short-term, like saving for a vacation in a couple of years, you might want to opt for lower-risk investments, such as bonds. Risk tolerance is another crucial factor. Everyone has a different comfort level when it comes to risk. Some people can watch their investment's value rise and fall dramatically without batting an eye, while others prefer a slow and steady growth. Understanding your risk tolerance will help you choose the right mix of investments. Next, consider your investment horizon, or how long you plan to stay invested. If you have a longer investment horizon, you can afford to take on more risk because you have more time to recover from any potential losses. But if your horizon is short, you'll want to stick to more conservative investments. Now, let's talk about the types of investments. Stocks represent ownership in a company and can provide high returns but also come with higher risk. Bonds are essentially loans you give to a company or government in return for periodic interest payments and the return of the loan amount at maturity. ETFs, or exchange-traded funds, and mutual funds are collections of stocks, bonds, or other assets, offering diversification in a single investment. So take your time, do your research, consider your goals, risk tolerance, and investment horizon, and then make your first investment. Remember, the goal is to invest in something you believe in and are comfortable with. Once you've made your first investment, what should you expect? Well, it's a bit like setting sail on a vast, unpredictable ocean. There will be calm days, stormy days, and everything in between. The financial market, like the ocean, ebbs and flows, with peaks and troughs that can be as exhilarating as they are nerve-wracking. But fear not, for investing is not a test of who can weather the wildest storm, but rather, it's about who can stay the course. Patience and consistency are your trusty compass and sturdy anchor in this journey. They'll guide you when the market soars and hold you steady when it plunges. In this voyage of investing, one strategy that can help smooth out the rough seas is dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. It's kind of like buying supplies for your journey. Sometimes you'll buy when prices are high and other times when they're low. Over time, you may find that you've purchased more at lower prices and less at higher ones. This can potentially lower the average cost per share of your investment, hence the term dollar cost averaging. Another key element of this journey is the concept of reinvesting dividends. When your investments pay you dividends, instead of taking that money and spending it, consider reinvesting it. It's like using the wind in your sails to propel you further into your journey, accelerating the growth of your investment portfolio. Remember to regularly review and adjust your portfolio too. Just as a ship's captain must adjust the sails and course according to the changing winds and currents, so too must an investor adapt to the ever-changing market conditions. Investing is a journey, not a sprint. With patience, consistency, and a $100 start, you're on your way to financial growth. So set your sails, steady your course, and let the voyage of investing begin.